Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And today's video is going to be on Lithium Motors, one of the hottest stocks in the marketplace today. And I thought it would be a very interesting stock to showcase. A lot of you might not be familiar with the company. It's a small cap, $3 billion market cap. The company is one of the largest automotive retailers in the country, and it tends to operate in urban and rural populations, and their whole approach to selling cars is to make the process simpler and more straightforward so that buyers of their automobiles can be more confident in their purchases. And you can see they've done a really good job. So let's look at its historical earnings results and point out a couple of attributes that are quite interesting. Number one is you can see that the company has tracked earnings going back to 2000 very closely at around a PE of 13. That's been their normal PE over this time frame. They did suffer a little bit during the Great Recession. They even cut their dividend, and the stock price, you can see, tracked that nicely. But since coming out of the Great Recession, the company's grown like a weed. Now, I want to point a couple of things out. Their growth as they were recovering from the recession was extremely strong in 2010, averaged 88%. It was over 100% in 2011. And then it kind of settled down into more of a double-digit growth rate. So the growth rate has averaged 31%. If I chop a couple of years off, the growth rate is now averaging about 18%. Forecast growth is about 10%, and the longer-term trend line growth is about 15%. These are forecast growths now. So this company is still considered to grow. Now, I want you to notice that it got very undervalued throughout 2018, and it really, for no apparent reason, in my opinion, other than perhaps politics or talks of recessions and things like that, because the company's earnings growth in 2018 was 19%. It's estimated to be 13% today. Now, the company had a pretty strong earnings beat this morning and reported it. And so if you look at the stock and how it's trading today, you'll see that it's up very strongly. As I said, it's one of the hottest stocks. So getting a Morningstar quote here, you'll see that the stock is up almost 16.5%, up $21.42 as I'm producing this video. So it's got very strong results. But one of the reasons I wanted to share this relatively unknown stock is that, it's a good quality company, has modest debt. It's double B plus rated, which is good for a small cap, $3 billion market cap, $6 billion, almost $7 billion in total enterprise value. But I want you to see the effects of undervaluation. Now, the stock was significantly undervalued coming into 2018. Thus far, prior to today, the stock is already up 70%. And again, it's up another strong 16% today. So it's a hot stock. It still has good opportunity. It's got good momentum. Zacks research gives it A for value, an A for growth, and an A for momentum, what they call their VGM, or their value growth momentum score. So, looking out, the company, even though it's up today, it still has good potential going out for the next couple of years. And this is a growth stock that you might want to take a little closer look at. It does pay a modest dividend, but it's really not about the dividend in this case. As you look at historical performance since 2013, you can see it's done almost double the S&P 500. If I go all the way back to just after the Great Recession, you can see that it's averaged over 30% a year and has paid a substantial dividend because the dividend has grown at a very high rate, even though it's relatively minor. Their dividend payout ratio, as you can see, is in the teens here. It's paying out 11%, actually. It's even below the teens, 12% in 2017. So it pays a modest dividend, less than 1%, but it's really a growth story, and it's a growth story at about a 14 PE ratio. So when I'm looking at forecasting and I go to the normal multiple, I think, using something around a 14, I'll use 14.27 here, you could see that there could be a short-term annualized rate of return over 28% out to 2020, and it could still be about 20% out through 2021. So, the stock has momentum now. You might want to watch for a little pullback. From an earnings surprise, they had a very strong earnings beat, which is what caused the growth. If you look at the company historically, it has a very excellent analyst scorecard. The company has met or exceeded estimates the majority of the time on both a 1-year and a 2-year. They've only missed estimates 10% of the time on the 2-year forecast. Obviously, the further out the analysts are forecasting, the less likely the forecast is to be good. So anyway, this is a high momentum stock. It's one of the hot stocks in the marketplace today. I just wanted to give you a better look or a closer look at what the stock looks like from a valuation perspective. I still believe it's very, very attractive, even after the strong run up this year and even after the strong run up today. Anyway, this is one that I haven't covered before. I hope you found it interesting. If you go into the company's website, and it's something I would recommend doing, you can see that they have over 70,000 vehicles in 185 locations nationwide. The company is, a good dealership. It sells cars very simplistically, as I mentioned. So it's not necessarily for everybody, but it's one that some of you may want to take a closer look at. Anyway, this has been Chuck Carnevale covering Lithium Motors. Thanks for watching. If you like what you see here, don't forget to hit our subscribe button. It's free, and subscribe to our YouTube channel. Thanks.